So good morning, everyone, and welcome to the University of Nebraska, Omaha, College of Business. I'm Jane Liu from the Economics Department. We are honored to host Mohnish Pabrai, an internationally respected investor and a thought leader. Please join me in welcoming our Dean of the College of Business, Dr. Steve Schatz.
Thank you, Dr. Liu, and I want to thank everybody that is here today.
So it's now my privilege to introduce our key speaker, Mohnish Pabrai. Many of you know him as a renowned value investor and the founder of Pabrai Investment Funds. So please join me in welcoming Mohnish Pabrai.
It's a pleasure to be here, and thank you to university for hosting us. I'm always very happy to be on the campus. I think it's a wonderful business school and campus, so thank you so much for having all of us. And this time we set up a live stream, and they ran out of licenses for the live stream, and then they were gracious enough to increase those. So I think we have about 1,000 people joining us online, which is wonderful. So to me, I think the best way for me to learn is to teach. So I have an ulterior motive for doing this, which is I'm just trying to teach myself, and so you guys are along for the ride, which is just fine. And so the talk I'm giving today is a new talk. You only need to get rich once. You don't need to get rich multiple times. You only need to get rich once. And I just wanted to remind myself of that. And so I'll go through a few slides, and then I'm most interested in what you guys want to talk about, whether it's part of what I talked about or something else, that'd be fine. I'll get going. Some of you might know that in the late 1960s and early 70s, there was this concept of the Nifty-Fifty, which is different from the Nifty-Fifty that exists in India right now. But the idea was that you bought 50 of these blue chip stocks in equal denominations, 2% each. And you really didn't care about valuations or anything. You just bought these dominant businesses, and then you kind of set it and forget it. And it was supposed to do extremely well, and it took off. Nifty-Fifty became extremely popular. And then we had the big downturn in 1973 and 74, which was kind of a big crash in slow motion. I think over a 2-year period, markets were down more than 50%. And the Nifty-Fifty basically got taken out back and shot. So by the time we got around to 1975, nobody was invested in the Nifty-Fifty. I mean, that was kind of over. There is some controversy whether Walmart was part of the Nifty-Fifty or not. Walmart went public in 1970. In order to make my talk more interesting, I'm going to assume that Walmart was part of the Nifty-Fifty. So if you think about Walmart being part of the Nifty-Fifty and being 2% of the Nifty-Fifty, so if you had invested $100, $2 would have been invested in Walmart. And now the Nifty-Fifty had many stocks that went to zero. Xerox, Polaroid, Kodak, a whole bunch of companies that were high flyers that eventually went nowhere. But if you make an extreme assumption, which is that 49 of the 50 stocks went to zero. So let's say everything except Walmart disappears basically to nothing, even though there were companies like Coca-Cola, American Express, ADP, a lot of very strong businesses that are with us even today. But if you just assume everything's gone, 2% left in the Nifty-Fifty blew out the S&P 500 over the last 55 years. And so if you looked at just $2 invested in the Nifty-Fifty, 98 going to zero, and $100 invested in the S&P 500, the S&P did very well. It's like a 320x since then. It's up to 32,000. But Walmart alone at the $2 blows out the S&P, becomes 126,000. It's like a 64,000x basically return, if you will. And so there's a number of lessons here in the sense that we know that there are power laws in investing, and we know that most stock market returns come from a sliver of few businesses. And it's important to be in those businesses for the long term. And so if we just switch gears a little bit and we look at Berkshire Hathaway, which is why we're here this weekend. And this is the 60th anniversary of Berkshire. And Warren had made these comments 2 years back in the annual letter to shareholders. And he said, in 58 years of Berkshire management, most of my capital allocation decisions have been no better than so-so. Our satisfactory results have been the result of about a dozen truly good decisions that would be one every 5 years. So if we look at Berkshire in terms of the last 60 years, and we try to examine how many decisions, important decisions, Warren has made in the last 6 decades, we know they bought more than 80 businesses. The common stock investments they made, I put down 210. I think it might even be double that number. It might be 300 or 400 stocks that they've invested in over the last 60 years. And then key hires by Buffett would be probably more than 10. But, let's say he had at least 10 key hires. So he probably had, in reality, probably 400 or 500 important decisions that he made over the last 6 decades. And in the slide I put down 300 so to get to a 4% hit rate. But basically the hit rate for someone like Warren would have been like 2 to 4%. So just 2 to 4% of the decisions that he made is what has led to all of our interest in Berkshire. And the remaining 96 or 98% kind of didn't matter. Very similar to the Nifty-Fifty where the 98% didn't matter. It was just the 2% that really move the needle. And I don't know whether these are the 12 decisions he's talking about. I took a stab at it. I know that Ajit Jain is 12. Charlie used to talk about like the best return Berkshire ever got on any investment was the search fee they paid on hiring Ajit Jain. I think Ajit alone has created like north of 100 billion in value for Berkshire from scratch, basically. But, See's Candy would be in there, and Coke would be in there, and Apple would be in there, and National Indemnity would be in there, and Mid-American, so on. So it's been just a few decisions that have led to this outcome. And the important thing about these 12 decisions was it wasn't the decision to buy them that was important. The important thing about the 12 decisions was the decision was to hold them. The hold decision was more important than the buy decision. And it's the same thing with Walmart, right? I mean, Walmart being part of the Nifty-Fifty wasn't that important. It was not doing anything with it for a long time. That was very critical. And my friend Nick Sleep in the UK used to run the Nomad Fund and with his partner in crime, Case Zakaria. And they ran the Nomad Fund from 2001 to 2013. They'd compounded at 18+% a year over that period. And they had about $3 billion in the management when they decided to return everyone's money and close the funds, basically, move on. And the reason they did that was that Amazon was a bet they had made earlier, and it had become a large portion of the funds because it had appreciated so much. And the UK regulator was giving them a lot of grief about the lack of diversification and the high degree of risk with so much in one position, etc., which of course they didn't agree with. And they looked at each other and said that, and I'm estimating that they probably had a net worth at that time of about 400 million, about 200 million each. And they probably looked at each other and just said that we never expected to be this wealthy. And why do we need to manage anyone else's money? If we've just managed our own money, no one can tell us what to allocate. So they decided to basically return everyone's capital. And Nick wrote his investors a letter saying that I'm taking my money and I'm putting 1/3 into Berkshire, 1/3 into Costco, and 1/3 into Amazon. And he said that you can do the same. And you don't need to pay us any fees. And at least for 10 years, you don't need to do anything with it. You can just keep it that way. And I got a panicked call from endowment who got this letter, large university endowment in the US. And they said, Mohnish, did you see that Nick is shutting down his fund and returning our money and all of that? And it's terrible, And I said, yeah, but he told you what to do. And he told you what to do, and now you can do that without paying any fees to anyone. So he says to me, yeah, but we are not allowed to buy stocks directly ourselves. So I said, so do you want me to set up a fund and I'll buy those 3 stocks and I can set up a 2 and 20 structure and then everything will be okay? He said, yeah, that would work. So that's just the way the world works. I didn't do that. That would be so, I don't know if I'd be able to sleep at night, But yeah, it's just the weirdness of the way the world works. But Nick put 1/3 of his money in these three stocks, and basically Amazon kept going up after that. And it became, I think, 70, 80% of the portfolio. And he was concerned. And so he decided to cut the Amazon stake in half. And he put that in what I consider a loser company, ASOS. ASOS is a company in the UK, which is run by, I think it used to be run by a guy who was the former head of Amazon in the UK. But, fast fashion, clothing, whatever. So ASOS did not go anywhere, didn't do anything. And we know that's going to happen because we know the hit rates are so small. So if Nick had done nothing at all, his portfolio today would be about 1.7 billion. Even with the ASOS misstep, it's 1.4 billion. And if he had just put it in the S&P, it'd be about less than 800 million. So worked out extremely well for Nick, even with the adventures with ASOS. And the other thing is that Nick pretty much trounced everyone after 2014 while doing no work. He likes to do racing on racetracks. He's got a few cars, and he likes to go bike riding across China and whatever. He has a lot of different activities and hobbies, and he fully pursued those while the portfolio kept doing its thing. And it worked out just fine. I don't think he's had any regrets about any of it. Then you look at myself, that's why I'm giving this talk, is really to just educate myself. We used to, in 2014, own about close to 14 million shares of Fiat Chrysler. And within that 14 million shares was 90% of Ferrari. And when Fiat Chrysler spun out Ferrari, they gave all the shareholders, for every 10 shares of Fiat Chrysler, you got 1 share of Ferrari. And basically at that time, Pabrai funds owned 0.7% of Ferrari, 2/3 of 1% approximately. And in my infinite wisdom, I thought Ferrari was too expensive, overvalued. They were IPOing it. So I said, they've timed this perfectly, etc. And so the whole adventure with Fiat Chrysler and Ferrari was very profitable for Pabrai funds. We had invested about 70 million and we collected about 260 million. And out of that 260 million, 100 million came from Ferrari. But if I just kept Ferrari, that alone would be about 640 million now. And it's not the only one. There's a long list of these, There's a shipping company, Frontline, I had put 10% of the portfolio on. I lost count, it went up 350x. We got a double and then it went up 350x. And so we've had a few of these bloopers along the way. So I try to kind of understand, how do we avoid these things? So obviously, the first thing, which is great investment ideas are very, very rare. If God, also known as Mr. Buffett, finds 12 of them in 60 years, then what hope is there for the rest of us? And so one of the first things I realized was that it is really dumb to sell a business purely because it's overvalued. And the reason that's dumb is that we actually don't know usually whether a business is overvalued or not. We are trying to figure it out, but we may not understand the business well enough to know whether it's overvalued or not. And what I find interesting about Nick Sleep's example, and I'll go through a couple more examples, is that if you think about Nick's portfolio, because he was going to go on autopilot with the portfolio, if you think of his portfolio when when you are rich and you want to stay rich, and I'm sure that was a consideration Nick had, when you look at the 3 bets he made, which was Amazon, Costco, and Berkshire, I would say that the most resilient of the 3, in my way of thinking, would be Berkshire. Just because it's so diversified and Warren and Charlie focused on, downside protection and all of that. The other 2 bets also are extremely good bets. They're very, very good businesses. We have not seen any decline in any of these 3 businesses in the last 10 years, and I would be surprised if we see declines in these businesses in the next 10 or 20 years. All 3 bets are extremely good. But Berkshire especially is interesting because Berkshire almost is like an index in the sense that it's very diversified, lots of different income streams. And so one can take a lot of comfort in that situation. The other thing is that when you think about Nick's situation, let's say, for example, the 1/3 allocations become 80% Amazon and 10% Berkshire and 10% Costco, which is approximately where he was, I think, at that point. It still should not have mattered to him because the 10% of the pie that's in Berkshire would still be more money than he could possibly use in a lifetime. So once you're rich, the concept of optimizing after you're rich is likely to hurt more than help. So because there was the anchor of Berkshire, one could, in effect, let it ride. And I'll give you another example, which will maybe illustrate this point. There are 2 or 3 examples that'll be interesting for you to look at. So we talked about Walmart and the Walton family. So Sam Walton had transferred ownership of Walmart to his kids when Walmart was a very small private company. And so when he passed away, there basically was no estate tax because the shares were already owned by the next generation. And the Walton family today, 55 years after the IPO and 33 years after Sam Walton's passing, still owns 46% of Walmart. And it hasn't changed that much from the time of the IPO. So in 46 years in 55 years of being a public company, the Waltons would have been approached by a lot of helpers. We have a lot of helpers around. And the helpers would have come up with all kinds of, diversification schemes and whatever else for them. And they, for whatever reason, decided that we don't need the helpers. We're good, right? And they kept it. And I actually would think that this approach that the Walton family took is somewhat risky compared to the approach that Nick Sleep took, in the sense that Nick had the Berkshire Hathaway anchor. Walmart is a single company, it's a retailer, one of the most competitive of the different industry codes, et cetera. But they understood some things about Walmart and they said, okay, we can put all eggs in one basket and go for it. And they're the richest family in America now. Now, if we look at Microsoft, one of these things which I mentioned, which is you don't sell a business because it's overvalued. In the year late 99, early 2000, Microsoft's valuation went crazy. It was one of the 3 most valuable businesses on the planet, 600 billion market cap against single-digit billion cash flows. So it was really incredibly overvalued at that time. And I used to think at that time, around 2000, that it was dumb to own Microsoft because it was so overvalued. And that was correct because for the next 15 years, the returns were zero. In fact, it wasn't the zero, it was a violent ride. It lost a lot of market cap and then came back. When Microsoft went public, Bill Gates owned 45% of Microsoft. And do you know how much he owns today? It's less than 1%. So Bill's taken his ownership stake in Microsoft down from 45% to 1% over this period. No one probably knows Microsoft better than Bill Gates. He knows it cold. And in many ways, I think my middle name is Forrest Gump. And in 1995, 30 years ago, I was running a IT system integrator that I had founded in Chicago. And we were a Microsoft solution provider. And Bill Gates was coming into town, and they had invited some of us solution providers to have lunch with Bill. And I said, okay, where do I sign? So there were about 10 of us, and we had a nice lunch with Bill Gates. And I asked him a question then, and I asked him about what he thought the durability of Microsoft was. I asked him where he thought the company might be in 10, 20, 30 years. And he was extremely bearish. So he said to me that the history of, if you study businesses, dominant businesses, all of them go into decline. Almost all of them go into decline. So the likely end result is that Microsoft will go into decline. And I think that when Bill became extremely wealthy, he started a program of automatic selling of Microsoft stock so that no matter whether he knew information or not, he could continue selling. And they kept selling and buying a diversified set of other businesses. And those have done reasonably well, but they have not done as well as Microsoft has done. And then we have Steve Ballmer, hired gun. And when I bring up Steve Ballmer to some of the professional fund managers, they do not have pleasant things to say about Steve. Because they say, in that tenure of, Steve Ballmer's tenure is that 15-year tenure. Okay, that's when Steve is the CEO. It's not his fault. He gets an overvalued stock, and then what's he going to do? No matter what he does. I mean, Microsoft's cash flows went up a lot, but, he was facing a big headwind. When Steve first joined Microsoft, he dropped out of Stanford Business School, and Bill Gates convinced him to come on board at Microsoft. And the deal he had was $50,000 base salary and 10% of all incremental profits generated by the company after that. Okay, and in a few years, the 10% of profits was a massive number. Okay, so Bill sat down with Steve and said, this is not sustainable. We can't do this. We have to cut a different deal. And the deal they cut was that he would no longer get a percentage of profits, and he'd get 8% of Microsoft. And so that's what happened. He was given 8% of Microsoft. And Balmer, even though he's sitting with Steve, with Bill, and even though I'm sure they had the same discussion about the durability of the Microsoft franchise, whatever else, never sells any shares, right? And Microsoft issued a lot of stock for stock options and all that. So Balmer's stake in Microsoft today is 4%. It's 4% of more than 4 times what Bill has. And now he's wealthier than Bill. Hired gun, wealthier than the founder, right? And what I find interesting about Balmer is he made the best decisions of all these guys. I think he made better decisions than Nick Sleep. He made better decisions than the Walton family. He made better decisions than Bill Gates. What he did was he collects about $1 billion plus in dividends every year, just coming in. And those have gone into the S&P 500 index. So Balmer now has about 25 billion or something sitting in the S&P. And he's got, 120, 130 billion sitting in Microsoft. So whatever you think happens to Microsoft, even if the S&P is overvalued, tens of billions are going to still be there. And so it takes away all the concern he might have about going to the poorhouse or becoming not wealthy again or any of that. He could let it ride because he's got the anchor of the S&P. And then, obviously what happens after that was a total outlier where he brings in Satya. And of course, Satya hits it out of the park and it's been great. But it's interesting to see Microsoft in the context of these different leaders and different owners and how they dealt with their stake. And if you look at Coca-Cola, which is a position that's a large position for Berkshire, it went through the same situation where it went through a 12-year period of no returns. And if you go back and look at the transcripts of the discussions Warren and Charlie had, especially what Warren was saying about Coke in the late 90s, as the PE was rising, he just felt it was an impregnable moat. It was the ultimate. And a few years later, I was surprised he actually said that it might have been better to sell because, again, Coke was sitting at such a euphoric valuation that as the business continued to do well, just like Microsoft, it went through a 12-year period. But again, going back to the maxim of not selling a business when it's overvalued, in the longer fullness of time, it still works out okay. And in the longer fullness of time, Berkshire's still done perfectly fine. I mean, even though they suffered through that 12-year period with Coke and such. So those were some of the thoughts I wanted to share with you. And I really wanted to share because I wanted to kind of hear them myself, and try to understand a few things about the way the world works. So thank you so much. And we can take your questions.
So thank you, Mohnish, for such an insightful and thought-provoking presentation. So next, I will do an interview with Mohnish, and then we will start a Q&A. So we will do a 30 minutes interview and then 30 minutes Q&A. So Mohnish, it's your third time at UNO. So yeah, so we've been starting this since 2022. And over the years, we get a bigger and bigger audience. So this year, we have all you guys here and also 1,000 people online. So I guess most of you here are investors, right? And are value investors. So how many of you following Mohnish on Twitter? Raise your hands. Oh, awesome. So how many of you would identify yourself as a value investor? Cool. So we will start questions with value investing and investment philosophy. So in your book, Mohnish, you emphasized the power of a low-risk, high-return strategy. So how has that approach evolved over time, especially in today's fast-moving and tech-saturated markets?
I think that's a good question. So because there are 50,000 stocks or so around the world, there are large numbers of them that are mispriced at any given time. And they can be mispriced as being too cheap or too expensive. And if we focus on the ones that are mispriced on the right side of the scale, then that's what makes this interesting, because we get a free lunch, where we can once in a while get a chance to make investments where we are basically be able to buy assets well below what they're worth. And usually we are not able to do this if markets are not auction driven. So if we are looking at negotiated transactions and things like that, then you don't have as much of an opportunity. But auction driven markets tend to overshoot and undershoot a lot. So we can actually take advantage.
You've championed the idea of a rigorous investment checklist. So what are the few items that remain critical for you today? Can you share how this framework has helped you avoid major mistakes?
Yeah, the checklist actually is a very useful tool, and it's helped us in aviation a lot, where air travel has become extremely safe, mainly because of the use of checklists by pilots, and before they take off, before they land, and so on. And I had applied the same concept. So the aviation checklist came about from examining failures. So when a plane crashed, the FAA would always go in and try to figure out why did the crash happen. And then the FAA actually takes a pragmatic view of reality. They have a definition of what a human life is worth. And I haven't kept up, but it used to be around $10 million a few years back. So when they see a plane crash and they see that so many lives were lost, they try to figure out that if nothing was done, how many lives would be lost over the next 5, 10, 20 years. And then they multiply it by that 10 million number. And then they now know, okay, we would have a $4 billion loss, for example, in dollar terms if we did nothing. And then they look at, if we ask industry to make changes to aircraft design or whatever else, what is the cost of that? And they will only make those changes if the cost is less than the $4 billion. So it's a very pragmatic approach, because you don't want air travel to be so expensive that we cannot get on an airplane. And you don't want it to be planes crashing all the time, because that also doesn't work. So they've kind of chosen this middle path, which has worked really well. And I did the same thing when I had developed a checklist for pre-investment checklist. Is I looked at great minds of investing who had investments they made that didn't work, but where the reason why the investment would not work may have been obvious before the investment was made. So like, for example, Berkshire buying Dexter shoes, right? I mean, the concept that low-cost foreign manufacturing may impact the moat should have been visible to Warren and Charlie. It was not that hard to think about that. And so then I would add that as a question to the checklist, that if this product were manufactured in another country, could that affect the moat? Could that affect the profitability, et cetera? So like this, I looked at many, many investments that had failed by great minds. And then I recategorized them into different buckets. And it was really interesting, because the number one reason for business failure, when I finished all the work on recategorizing them, was the number one reason why investments did not work was leverage. The single greatest reason why investments failed was because the businesses were levered. And the second reason why the investments didn't work was some misunderstanding of the nature of the moat. And then, there were other issues, trade unions and different things, but these were the two big ones. Like either the moat was not properly understood or the leverage is really what did the company in.
So the next one is about staying within the circle. So the circle of competence is a core principle in your investing style. So how do you define that circle today? And what practices helped you stay within it, especially as new industries and trends emerge?
Yeah, I think circle of competence is a wonderful tool that Graham and Buffett and Munger have emphasized and stressed for a long time. And there are a few interesting things about a circle of competence. The first is if you ask the question, if something is within your circle of competence or not, you've already answered it. To ask the question is to answer it, which is it's not. The fact that you're questioning that is this something in my circle of competence means it's not in your circle of competence. The second issue with the circle of competence is that we don't really pay much of a penalty if we have a very narrow circle of competence, very small circle. So people are always trying to broaden their circle of competence. But quite frankly, you could always have a narrow circle of competence and do extremely well. And the most important part of the circle of competence is not the size of the circle. It's staying in the epicenter. That's the most important, is staying in the epicenter of the circle. So if we look at most entrepreneurs have a very narrow circle of competence. They are an inch wide and a mile deep. And if they were not that way, they would not be able to build successful companies. So most entrepreneurs don't know a lot about many things, but they are able to do extremely well because they know a lot about what they are focused on. So that works out well. So staying within the circle, being in the center, it's a natural process in investing that over a lifetime, the circle will expand. It's just if you're reading and thinking and, experiencing different things over time, you'll understand more things about how the world works, and so the circle will expand. So we don't need to have some deliberate endeavor to expand the circle. It'll expand naturally. And we also need to be very clear on saying no very quickly when something is outside a circle. It's a big exercise in humility. So Buffett has this too hard pile box on his desk. It's a physical box that says too hard. And he says that 99% of stuff should go into it. So most things that we encounter from an investing perspective should go into the too hard pile. They should be outside circle of competence. And we should not be trying to figure everything out.
Next set of questions around global markets and the macroeconomic forces. So you've invested in countries like India and South Korea. What makes emerging markets attractive to you? And what unique challenges or risks do you watch out for now?
Yeah, actually, we made several investments in South Korea. None of them worked. Thankfully, in most cases, we got most of our money back. And I think the similar situation in India. Most of the things I did in India did not work. A few things worked, but most didn't. And it goes back to the same issue of the 4% hit rate Warren Buffett has, or the Nifty-Fifty and so on, is that in investing, we are doing really well if our error rate is 50%. John Templeton used to say that the best investment analyst is going to be wrong 1 out of 3 times. Most of us are going to be wrong more than 1 out of 3 times, maybe even half the time or more. So it's not to say that you can't do really well in South Korea, or you can't do really well in India. I couldn't do well there, and found other places that we could do well.
So next question is about volatility as a long-term advantage. So you said volatility is the friend of a long-term investor. Could you expand on how you've used the volatility as an opportunity, especially during the times of panic or uncertainty and maybe the past few weeks?
Yeah, I mean, I think that if we look at stocks as businesses which have an intrinsic value, whatever causes that value to go down is an advantage for us long term if it's within the circle of competence and such. And so volatility is always our friend. I mean, I think it's the reason why we are all interested in auction-driven markets is that they will undershoot and overshoot. You know, some news comes out and Coke will go down in price. Did their long-term cash flows go down from some particular news? So when you try to overlay news events that are moving markets and then you overlay them on a particular business, you may find that the correlation is very weak. And when you find those weak correlations, that usually is a sign that there could be opportunity there in the sense that something is being mispriced then.
Okay, so the next one is about macro and micro striking the balance. So how do you balance macroeconomic forces like inflation, trade wars, and global instability with deep company-level research? Have recent global events changed your weighting of macro in your decision-making?
So for most investments that we would make, the micro would trump the macro. And for most companies, it is internal decisions that they are making and their competitors are making that are going to drive most of the outcome. And usually it is hard enough to try to figure out what a business is going to look like 5 or 10 years from now, just looking at those factors, just the internal and market forces around that business. If we start to try to overlay macro things on top of that, I think we're going to get lost for the most part, because I don't think it becomes very hard to handicap. So we want to try to look at things where the thesis is very simple. And the thesis is well understood from an internal perspective. So if you look at a company like, let's say, Saudi Aramco, which is now publicly traded, I don't know, 3 trillion market cap or something. It used to be that when Saudi Aramco produced oil, their cost used to be like $2 a barrel to bring the oil up. And now, I don't know, it might be like $10 a barrel. So it's an insanely profitable company in almost any environment, right? So does it matter if you are a Saudi Aramco investor? Now, investing in Saudi Aramco has issues because the state takes a lot of the upside, but if it was just a normal business where you got a $10 and a barrel cost of bringing oil up, how does it matter whether oil price is 30, 50, 70, 100, 150, or 300? In all those price environments, you would make money, right? I mean, it's just whether you would make a lot of money or little money, but you'd make money. And if you were buying Saudi Aramco stock where the thesis would work for you in terms of returns and cash flows, if the oil price was more than 30, for example, I think you could ignore the macro. You could ignore everything because the likelihood of oil going below 30, 80% of production would shut down globally if that happened. So it's just we're unlikely to get there. So we want to look at bets like that where we can focus on the micro situation within the company, and we just find that there are these economics. And if I look at a business like Ferrari, for example, a car they sell for $2 million. So Ferrari will announce some car for $2 or $3 million. And they have a list of owners of Ferrari around the world ordered by the number of Ferraris they own. Some have 50, some have 30, whatever. They go down the list from their most preferred customer to the least preferred, and they'll just make calls to the top 500 customers saying, we're coming out with this car in 18 months, it's $3 million, do you want it? And the first 500 calls they make, they'll all say yes. And because they all know that one day after they get the car, they could flip it for $6 million. But they also know that if they flip it for 6 million, Ferrari won't call them the next time. So those cars are gone before they're produced. Ferrari's cost on that $2 or $3 million car is like 85% margins, maybe 90% margins. And so how do tariffs affect Ferrari? Irrelevant, not really relevant to the whole scheme of things. Because rich men, mostly Ferrari buyers are rich men, have very few ways to express their wealth. That's all you need to understand. So you understand Saudi Aramco, you understand Ferrari, who cares about the tariffs?
Okay. So, yeah, moving to the next part is wisdom from Buffett, Munger, and cloning mindset. So you've often credited Warren Buffett and Charlie Munger as guiding lights. What are some of the most enduring lessons you've applied from them in your own investing journey? So Charlie left us. So after a few years, like you looking back.
Well, like I said, my middle name is Forrest Gump. And we're not supposed to be able to touch these guys. And they both became friends because I'm Forrest Gump. So I got to see them up close. I got to see Charlie more up close than Warren. But I don't think it was even that necessary to see them up close. I think that the body of work they have produced is so awesome. So I think that the best things about both of them have nothing to do with investing. They've everything to do with leading a great life. And whenever I'd meet Charlie, I'd probably meet him like 4 or 5 times a year for dinner at his place. Whenever I'd meet Charlie for dinner, he's always be sitting in the same chair, always reading something, whatever. And I learned a lot from those dinners, not because of what he said. I just observed the way he's interacting with his grandkids, the way he's interacting with his daughter-in-law or his sons or his daughters or his manservant or other visitors, and the way he was living his life, the kind of his habits with eating and dessert and things. So just observing him in the way he was had huge lessons for me. But I think that for all of us, both these guys put so much in the public domain, and that I think that we have so much to learn from them from that. And I think that if we learn only the investing side, we miss most of it.
I will ask one last question, and then it's your turn. So the last one is more personal. When we recently chatted, you mentioned your golf game and how you approach it with the same intensity and presence as investing. So doing everything with 100%. So how has that mindset influenced the way you make decisions? Not just in business, but in life.
Yeah, so I'm a new golfer, I don't have too many regrets in life, but one of my regrets in life is I should have started in my 30s. That would have been better. But the way I'm programmed is I usually go all in. If I get excited about something, I go all in. I've always found that if you go all in on something, you're going to get really good at it. I think we should think about what we are passionate about, think about what we're excited about, and try to overdose on those. Like, I got interested in golf. I found that it's a way more complicated game than I thought, way more interesting game. My club is like 9 minutes away. And the situation in my investing is that I was reading a quote the other day. The more you mess with your portfolio, the lower your returns. So I said, okay, everything I own, I don't need to do anything with it. Especially if you look at the talk today. We just need one hit and we're good. So basically the investments are in good shape. I still obviously spend time looking at things, but I don't need to, if we found no new ideas for the next 5 or 10 years, it's okay, not a big deal. So I said, okay, we'll go deeper into golf. And that's what we're doing. It's fun.
Thank you, Mohnish and Jane. Very inspiring presentation and the Q&A session. I want to roll back a little bit, maybe have Mohnish to elaborate a little bit more on how we find all those critical decisions, like the good business or the long-lasting mediocre business. Because I remember in your YouTube channel, you mentioned once that Warren Buffett, when he was young, he used to pick up old betting tickets at the racetrack and check if any were winners that people throw away by mistake. So it seems that Warren Buffett already have this kind of talent when he was young. But for other investors and how we find our opportunities, and I remember both you and Warren Buffett trust on the Moody's manuals. And I also want to know, like in this kind of AI era, like do you have other ways to find your options? Thank you.
That's a great question. And actually, it's a question that Warren was asked at an annual meeting. And his answer was, start with the A's. And so basically what he was saying is that there isn't a shortcut. So when he was collecting those racetrack tickets from the ground, maybe only 1 in 200 tickets is actually useful, right? 199 are actual loser tickets. But he didn't mind. He didn't mind going through 200 tickets to find one. And later, when he was going through the Moody's manuals, which he did the same thing, Moody's manual is very fine print. I think it's like font size must be 6 or something, and it's 1,500 pages, and there's 6 or 7 of them. So he went through all those manuals several times. And again, he was doing the same thing as what he was doing in the racetrack, which is he's going through one by one by one. And one direct example I can give you is that Buffett recently a few years back, he made the Japan bets, the 5 conglomerates of Japan that he bought. And he's been a reader of the Japan Company Handbook for many years. Japan Company Handbook, probably more than 10, 15 years, is like value line for Japan. It's in English, it's 2 companies to a page. It's very similar to the Moody's manual and all that. And I remember that I was visiting his office, I think in 2012, and I saw the Japan Company Handbook on his desk. And I was actually going through the handbook at the same time. And so I said, oh, Warren, there are some companies I already know are good in there that you can take a look at. So without waiting for him to answer, I took his book and I dog-eared some pages. I went ahead and took the liberty of dog-earing Warren Buffett's copy of his manual. And I told him a lot of the stuff is at the back of the book. He said, yeah, all the good stuff is usually at the back, right? I had then found that you could do the same thing as flipping through Japan Company Handbook 1 page at a time with Capital IQ. Capital IQ is a subscription, like $10,000 or something. The handbook is $100 or $50. But Capital IQ you could set up any screen, and in 2 minutes you basically got a condensed version. And I tried to convince him, and I actually work with Tracy Britt, to switch from the handbook to Capital IQ. And Tracy told me that he'll never spend the $10,000, okay? And he'll never do it this way, okay? And I said, but Tracy, I want you to know it so you can do it for him, okay? So I trained Tracy on how to use Capital IQ to do that. And after the training, she said, yeah, I know how to do this. He's not going to be interested, okay? And the thing is, at the end of the day, what ended up happening is Warren stuck to his old method. No AI, no nothing, no technology, flipping 1 page at a time. And he found those 5 bets. I didn't find those bets. He found those 5 bets, right? Now, it took him more than 10 years to find those bets. But in investing, we have infinite time. But those 5 Japanese bets, those are pure genius. Because the way he did those bets, so first of all, he found these companies They have an 8% dividend yield at the time he finds them. He borrows the whole thing in yen at 0.5%. Okay, so never puts up any of Berkshire's capital, even though they're drowning in cash. 7.5% instant yield delta of no money that he's put up. Then all those stocks double, their dividends double, so now he's got like 16% coming on the 0.5%, and then they've gone on beyond that. So that was just, and he was forced to do 5 because of the size of Berkshire. If it was smaller, he would have picked one and gone for that one. So I learned a lot of lessons from that, which is that less is more. And the second lesson I learned is fast is slow. There's a friend of mine from China. He's the founder of Oppo and Vivo. Yongping Duan. All the Chinese people here know him. Raise your hands if you know Yongping. There you go. They all know him. So Ping plays more golf than me. Okay. And Oppo and Vivo are both private companies. He lives in San Francisco. Every year, he goes to meet his management team running these dominant businesses in China. And he tells me that there's a big conference table with all his managers. And he says, I'm there for 10 minutes. And then I'm done for a year. I'll meet them after a year for 10 minutes. And he said, the last time I met them, I only said 3 words. And then I walked out. I said, Ping, what were the 3 words you told them? He said, I gave them these 3 words. And then a year later, they tripled the profits. So I said, what were the 3 words, Ping? He said, fast is slow. If you want to email Ping, his email ID is fastistslow@yahoo.com. Don't inundate his inbox. Okay? So he says that after I left, I don't know if you guys have ever seen the movie called Being There. Has anyone seen the movie Being There? It's before your time. They don't know. We know, right? You're like, yeah. So go back and see the movie called Being There with Peter Sellers. And then you'll kind of understand where this is going. So Ping says that after I leave the room, they spend 2 months trying to figure out what those 3 words mean. And they finally figure it out. And then they kill the competition. So fast is slow. Warren did the same thing.
Thank you for inviting us here today. I wanted to just kind of ask a question in terms of your thoughts. Last year, when we were at the meeting, it had just been announced that Warren had kind of reduced his Apple position. And I think at that time, if I'm not mistaken, it was about a 10% reduction in his total stake in holdings. And at the beginning of the shareholder meeting, he kind of implied some tax favorable consequences as to the reason why he was doing that. I mean, the stake had grown almost to $186 to $190 billion. He's reduced his stake by 2/3. Wanted to kind of get your thoughts as to kind of what you think and thought as to perhaps what the reasons may be in terms of how you view that reduction in that position, considering how publicly he has adored and admired Apple as being a core holding in his portfolio.
Yeah, well, I mean, that's why he's Warren Buffett. I mean, look how awesome that decision looks now. You know, I mean, the thing is Berkshire sitting on a huge pile of cash where a lot of things have been, drawn down in price. And yeah, I mean, the Apple situation is interesting because he's in effect destroying one of his best loved ideas, which is he wants to hold forever. And at the same time, I think he alluded to the fact that tax rates could be higher, but he might have also alluded to the fact that, is it fully priced? Or do I want to have more firepower for things that may come up in the future? I don't know. I mean, I'm just saying that I don't know exactly what his thinking was, but I'd say so far that thinking seems fantastic.
Mohnish Pabrai, I really appreciate your time. This has been fantastic. I'm a shameless copier of you, more so than Warren Buffett and Charlie Munger in aggregate. And the one thing I quote a lot is, heads I win, tails I don't lose much. And specifically, I'm looking at economic moats. When I'm looking at economic moats, I'm looking at the company I'm looking at, and then all the competitors, how they're going to encroach on these moats. But I've been right and occasionally wrong. And so how do you see economic moats and, more importantly, the durability, specifically with the company you're looking at, and the competitors who want to encroach?
Yeah, well, that's a good question. I think that it's hard to answer in generalities, but I would just say that when I'm looking at a business, if I can't get to very high conviction, and I can't get to the point where I could describe it to a 10-year-old in about 4 sentences, then I'm usually not interested. So at the end of the day, the thesis needs to be very simple. And it needs to be a very impregnable thesis. Even when we have a simple, impregnable thesis, we're still going to have a higher error rate. But it's going to be even higher if we don't have that. So I always want any business I invest in, I should be able to, in my head, know very quickly why that investment makes all the sense in the world and why it's going to work. Try to keep it. Most companies don't lend themselves to that type of clarity. But we don't need to invest in most companies. So once in a while, you can find something that is a simple situation and that can work.
Hi, Mr. Pabrai. Thanks for having us here. It's a pleasure being here. This is a question about debt. As everyone knows here, Berkshire Hathaway has grown throughout the last few decades without debt. And Warren Buffett in one of his letters said that debt creates an unnecessary stress for shareholders. But as we all know, in the early days of the Buffett partnership, he did use debt when he applied his cigar butt investing strategy. As he shifted to buying great companies, he started to stay away from debt. What are your thoughts on that? Because the argument there is, and from what I understand, is debt creates volatility in stock prices and in company performance. But if investors of Berkshire are long-term investors, does that matter anyway?
Well, that's a great question. There's a podcast many of you probably listen to, the Founders Podcast. I really like that podcast. I overdose on the Founders Podcast. And one of his episodes is on IKEA. And it's on the founder of IKEA. And IKEA is a private company. And the founder of IKEA was hell-bent of never, ever having any debt. And basically, when he looked at the business, he looked at it with a lens of IKEA being around 500 years from now, 1,000 years from now. Like, he looked way past his lifetime. And he tried to instill a bunch of principles into the company. Like, for example, one of his principles is that any store they open should not look like all the previous stores. It has to have some innovation that was not there in the previous stores. Whereas we think of retailers like, cookie cutter going through, but he's looking at every store becoming better than the previous store. And when I studied in the checklist, business failures, number one reason is debt. So Warren and Charlie have said that they could have generated higher returns for Berkshire without even taking that much leverage, with some leverage. And it would not have moved them that much over the risk curve, but they didn't want to go there, right? And I think they wanted to have this Fort Knox absolute, engine. So I think it's a very good idea for a company like Berkshire to be conservative. They effectively have leverage through insurance float. It's quite benign from that perspective, and it's helped them a lot. So I think that, them not going down the path of having leverage is a very good thing for all of our shareholders. It's wonderful.
Thanks for hosting us. When it comes to investing, I always have this question that, all these mega companies like Magnificent Seven companies, they have massive growth in terms of revenues and, the kind of revenue they are growing, because yesterday there was Amazon's earning yesterday, right? And they are planning to do like 1 trillion in revenue by 2029. So, I always have this thought, like all these companies, do you think we'll see a time in future, like all these companies will, continue to expand and, point of time we'll see that they will rival national power, or this government will try to, stop them from growing this big?
I would say that there's always an entrepreneur somewhere who's going to one-up the dominant players. So I'm not sure if that's what your question was.
Yeah, like Amazon, right? For example,
Yeah.
They are doing like close to 600 billion in revenues.
Yeah.
And like, let's say like I'm thinking of investing in the company, but I always have this thought like, I mean, will you think like they will keep on growing like this? Like at point of time, we'll see like they will, I mean, able to like, kind of influence government, or they will run the countries like that. I mean, because they're doing very massive in terms of revenues, right?
Yeah, but I think that in capitalism we have created restriction. So even a dominant company like Amazon, there's a lot of things they cannot do, a lot of things they will fail at, a lot of opportunities outside of that. So I'm not really concerned with that. I think that the nature of capitalism would keep them on their toes, even though they get dominance and they get some deep and wide moats in some areas. It's okay. I think it's just fine, no problem.
Thank you, Mr. Pabrai. Thank you for your great talk. And I came from South Korea, an undergraduate student, and I'm a big fan of investment gurus like Buffett, Munger, you, and Nomad Investments. But also, I'm a passionate scientist like immunology. So this is my concern. Many emerging industries today, such as drug development or deep tech, involve long timelines and heavy regulation and binary outcomes. So my question is, this seems far from the predictable or accessible qualities or expandable modes, which is the lessons from the value investing. So do you think it's still, or is there any kind of way to apply the principles of the lessons from value investing to recent rising industries like drug development or deep techs? How can we apply the lessons from value investments like expanding mode or qualities to the rising industries like innovative drug development or deep techs?
I think that industries with rapid change are the enemy of the investor. So in general, one of the things we look for when we're trying to get into value investments and so on is we need to have some idea of what the future cash flows are. And then we can discount those back. As you get more into tech-centered or innovative businesses, that becomes difficult. And I think one of the most brilliant things that Nick Sleep did, he and Case Zakaria, when they come to work in their office, Case did not have a desk. He had no desk to work on. He had a lazy boy chair. And he'd just sit in the lazy boy chair the whole day reading. And they would read these annual reports. So they sat and read hundreds and hundreds of annual reports. And of course, when they came to the Amazon annual report, it jumped out at them. And one of the things about Amazon for the longest period of time was there was no cash flow, right? I mean, it was reporting losses for a long time. And the adjustment both these guys had made is they were able to figure out effectively how much was being pumped into growth versus the existing business. And there was somewhat of a leap of faith that what Bezos was putting into growth was in aggregate going to produce very high returns. So they were able to apply value principles into a business like Amazon with spectacular results eventually. And so, yeah, it can be done if you understand the way the mousetrap works. So one of the critical things about Jeff Bezos was that he made many bets, but they were all small. So he threw a lot of stuff against the wall. And his assumption was that if those bets did not work, it wouldn't matter because the few that did work, the returns were so much higher. And AWS is a good example of something they stumbled onto that they had never actually planned on, right? I mean, one of the things about Amazon is that kind of a trademark of their approach is that they convert cost line items into new businesses. So, for example, we have UPS and FedEx. We don't yet have Amazon providing parcel services where I can go and just have Amazon deliver something to my aunt, for example, right, that I'm sending. But they could enter that business now because they have everything in place to enter that business. And my prediction would be that they will enter that business. And my prediction also would be that when they enter that business, their cost structure would be much lower than UPS or FedEx. They would really kind of create havoc for them. They're already creating havoc for them. So the Amazon analysis that Case and Nick did was not a cash flow analysis, right? It wasn't. I think what they were doing is they basically said, this is a very smart guy. He's a fanatic. He's very efficient in how capital is used. And he's going to have some of these that are going to work. And those are going to be extreme outlier returns. And it worked. And Amazon is still doing that. So from that point of view, it's exceptional. So yeah, you can do it, but I think you can do it in a very small sliver of companies like that.
Thank you so much, Mohnish and Jane, for organizing this for us. Really appreciate it. I'm Chloe from Singapore, and I want to ask your view on, I think one of the YouTube video that you mentioned, that index investing is probably like 4 to 6% ahead. Correct me if I'm wrong. But what's your take on this for long-term investment, especially Buffett? He has already laid out his view that 90% of his money for his wife will actually go into low-cost index fund. What's your take on that? Thank you.
Yeah, I mean, I think that if you go back and look at the presentation I made, when you are very rich, you don't need to optimize. So an investment in the S&P may not be the best investment, but it doesn't need to be. The important thing is 500 companies cannot sink at the same time. You know, these are 500 dominant companies. And so what he's looking for her to have is not have any issues with cash or cash flow or anything for the rest of her life. That's easily going to be accomplished with doing the S&P 500. And he also doesn't want her to be involved with buying or selling Berkshire or any of that, just keeps it separate and simple. So I think that it's a very sound decision. For the same reasons, the Steve Ballmer investment in the S&P 500 is also a very sound decision. Because, like I said, it just gives him the freedom to have a huge Microsoft position and not worry about it. So I think having something like a Berkshire in your portfolio or having a S&P 500 in your portfolio when you are wealthy is a very comforting place to be.
Hey, Aman here. I traveled from San Francisco. Mohnish, learn a great deal from watching your videos, just hearing you implement certain strategies. So my question is, how do you deal with psychology? Let's say when your investment is not performing for 10 plus years, you took example of Microsoft, which did nothing for 15 plus years. What, as an investor, you would be looking for that would distinguish Microsoft in that instance from the next IBM or Walmart from next Kmart or Sears? So how do you think about that? And psychologically, are there any hacks that you have developed that really helped you?
Yeah, so I think in the case of Microsoft, it was really simple. The business never ever went into secular decline. Basically had a very strong moat while the stock price was going down because it was overvalued. So it was very clear with Microsoft that there was no issue with the business itself. The issue with the price at which it was trading was the issue, which happened with many companies. Cisco had the same issue. It was trading at a very high valuation. And today we have a similar situation where many companies are very dominant, but they're trading at very high multiples. So it's relatively simple to separate the ones that are overvalued from the ones that are in decline. Once you can make that separation, then the second piece, which is, do you take a Steve Ballmer approach to Microsoft or do you take, Bill Gates approach, whatever? That's a second decision. But I think that I have an investment in Turkey. I've talked about a few times, Reysas, which is used to be very undervalued, still undervalued. So from my point of view, it's the easiest position to hold. And the reason it's the easiest position to hold is it trades below liquidation value. And there's nothing I can see that the business is in decline. So my decision will become more complicated once it gets past liquidation value, and if it gets past reasonable valuations beyond liquidation value. At that point, then the question I would have is, okay, it's a good business. Should I keep holding it, or should I do something else? And my biases right now would be that if the business itself is not in decline, just leave it alone and let it go. But I think you can normally tell the signal, separating the signal from the noise. Usually you can separate the signal from the noise if you just give it some time. So Microsoft did have an issue where they had euphoric revenues coming from all the dot-coms which disappeared, but their core business was pretty intact. And if I look at the business today, I see a business with some very solid moats. They're just going from strength to strength on their business. I see, going back to my Forrest Gump story, I think 2 or 3 years back, maybe, I think every Friday night there used to be a Munger dinner, Charlie Munger hosted. And his daughter-in-law pulled me aside and said, Mohnish, I don't want you to freak out, but I've seated you next to Bill Gates for dinner. You're going to be 2.5 hours next to Bill Gates. And she said, I seated you next to Bill Gates because I know you won't ask him for anything. I said, yeah, that's the furthest thing on my mind. I'm not going to ask him for anything. So Forrest Gump got seated next to Bill for 2.5 hours. So I said, Bill, can we play a game? I said, I'll name a stock, and you tell me whether you're going long, short, or neutral, right? And he said, yeah, sure. He was game. And I rattled off a whole bunch of tech names, and he was very quickly going through, giving me his perspective on what he would do. And I came to Apple, right? And he went into this long narrative where he basically thought Apple was a very peculiar company. He didn't say he would go long. He just said it's a peculiar company because, he said, unlike other businesses which have a lot of resilience, he said, everything was one guy. He's saying it all emanated from one guy. And the guy is gone, and really nothing is emanating since that guy is gone because they're still running on Steve Jobs' vision, basically. So his perspective was, in the end, he said, I wouldn't go long Apple, right? So basically, I think the issue is that when you compare a business like Microsoft to a business like Apple, I would 10 to 1 go with Microsoft just because of the recurring, the lock they have on us, in my opinion, is much stronger than the lock Apple has. Some people may disagree with that, but I think that the Microsoft lock is much stronger. So, but that's what makes this a market.
Thank you so much for coming, especially in person. Really, really appreciate it. I guess you essentially just talked a lot about how selling is very, very difficult and how basically we shouldn't sell. Is there any framework in which you decide when to actually exit a business? Or is there any position where you held very long and you regretted not selling?
Couldn't hear the last part. Can you just
Is there any position you've held long term that you regretted not selling earlier? Because you suddenly talked about you should not sell too soon.
Yeah.
But then is there any position where you've had that you regretted not selling earlier?
Well, I think my history has been basically all selling too soon. If I look at my portfolio, the longest I've held something now, probably 8 years, which is low. I think it should be more. And we still hopefully have a few more decades of compounding ahead. So the idea would be try to extend it. But I would say that if you look at what I was trying to communicate is that holding something for too long is not what's going to hurt you. Even if you end up basically with a suboptimal result of when you sell, right? So something goes from 10 to 100 and you keep it and it eventually gets to 30 and you sell it and you say, oh, I could have sold at 100. But that's not where the game's at. The game's at something goes from 10 to 500, right? And you kept it. So I think that's the part that is interesting here is that we can do very well without optimizing. We can do very well while being sloppy as long as the sloppiness is on the side of inactivity.
To follow up on that, you said you should not sell a great business because it's overvalued. So following up on what Susan said, like, how do you think about the transition from, what can cause a great business to become not so great?
Well, so there are two parts to the question, right? So the first part is, we'll go into the business decline later, but let's say a business is extremely good, right? And let's say, so there's fair value, overvalued, egregious overvaluation, right? Let's calibrate a little bit. I'm sure we could calibrate more, but let's say there's just those three. So fair value, we're perfectly okay, no issues. Overvalued also, we have no issues. The issue that only comes up is egregious, right? That's the only time when you really need to kind of think about it and such. And my general sense from what I have understood so far, and I don't know whether this is the right answer or not, is to have a pretty high bar on egregious. I'll give you an example. The thing is that this company in Turkey, they don't have an investor deck. They really don't explain their business. And they've gone into so many new businesses. One of the things I was looking at their history, they go into a new business, which they have no competence in. And in 5 or 7 years, they are number 1 or number 2 in the country in that space. Then they go into something else that they have no competence in, then they again end up with number 1, number 2. And I don't know whether I have fully understood why that is, but in observing them, what I realized is the son is what I would call an energizer bunny. So Buffett says this about Greg Abel, and he used to say this about David Sokol. And he says about Greg Abel is that, what Greg gets done by 10 a.m., I can't get done the whole day. Okay. And he used to say the same thing about David Sokol, that what Sokol got done by 9 or 10 in the morning, Warren would say, I wouldn't get done for the whole day. Right. So we don't have these linear relationships with different humans. I mean, we've seen that, you see some humans, they just are so off the chart, I mean, we have someone amongst us who's not even human. Elon, you guys think he's human. He's not human. He's not part of our species. How can someone from our species operate like that? Okay. So we get to kind of, these things that are off the curve, if you will. And I mean, Elon is a great example of what is the edge of his competency. Okay. I would not want to bet on what his edge of his competency is. I think that doesn't exist. So I think that this notion of egregious overvaluation may not apply with managers like Elon, right? Just because of what they're able to do, which we can't even comprehend. So I think that bar in my mind needs to be high. And yeah, we'll get tested on this. And so I noticed like the Reysas guy, I noticed the way they go about it and the way he steps on the accelerator, he gets way more done than what most other people would get done. And I don't know how to quantify that. I also don't know enough to know what the kind of boundaries of that are. So my take is that the good news right now is that I don't have to worry about it. Reysas is undervalued, easy. So when it gets to fair value, that's also easy. Gets to overvalued, that's also easy. If it goes to like 20 billion market cap or something, way before that, I'd be getting uneasy. Like what's going on here and such. So we'll see. But yeah, so if we don't have business decline, I think we need to be careful about trying to really understand all we can about the manager and the business and all of that. Now, we also have to understand, like Gates was saying, in the end, everything's a zero. Right? I mean, it's just the nature of things that everything ends up going to zero. So basically, if there is business decline, and with business decline, we have to separate the signal from the noise, right? So it's very important to separate signal from noise. But if it's, secular business decline, you have to get off the bus as soon as possible. And so you have to watch that carefully. But it's a tough thing because on one hand, you can't have it on a hair trigger. And on the other hand, you have to have clarity about what is signal and what is noise.
I think one of the notable things about your presentation was, I guess, how many of the structural winners were American stocks. And then you talked about Reysas at the end. And I was wondering whether you thought anything about the fact that it's, I guess, in Turkey, and whether there's something about the American system that contributes to companies becoming successful. It gives you pause about investing internationally.
I think you would find great winners everywhere. And I think that's an easy thing to even test for. You can go into different markets and you can go back in history and say which ones have been 100x or 200x or 300x in 20 years, and you would find them. And I think there are lots of examples of that in India, for example. HDFC Bank, Asian Paints, a lot of companies that have done extremely well. So I think those exist everywhere. I mean, the US is a very deep market, one of the largest markets, and free market capitalism. So there's a lot of things that are going for it. But I think you can find those examples everywhere. So that wasn't by design. It's just, I didn't spend a lot of thought trying to be politically correct about being inclusive, etc. I just went through and picked a few examples.
One thing that I thought was notable from some of the pre-reading I did was your kind of thought on specializing within a sector and saying, I don't want to necessarily know about the greatest businesses within the sector. I just want to know about what the greatest businesses are. And I'm curious about how that kind of informs your idea generation process, if it really is kind of certain themes that you find interesting in the moment, or how you kind of, what ends up getting expressed in brief.
Yeah, that's a great question. So I think when we all start out, we have a small circle of competence. That's the nature of our life experiences when we're young. We're not going to know a lot about a lot of things. And Buffett also says that we don't need to have some kind of structured program to expand our circle. I think that the quote, the Charlie Munger quote you use, which is, you're reading everything in sight, over time, your circle of competence is going to grow, especially when you make mistakes. That'll make it grow very fast. And so the circle is going to expand over time. But I also feel that it's important to understand that the most successful humans have very narrow circles. So if we go past investing and we look at entrepreneurs, they tend to be very narrow, right? I mean, the founder of Zara, for example, right? I mean, he's got or LVMH and so on. They're very good at what they do, but they're not everything on everything. So as investors, it is always better to have the focus to be an inch wide and a mile deep than to be a mile wide and an inch deep, right? So basically, our focus should be to get really good at what we know. And yeah, there's a lot of peripheral stuff that we don't know, but over time that will come in. And Charlie used to talk about his friend John Arrillaga, multi-billionaire, passed away. His daughter's married to Mark Andreessen, and John Arrillaga in his whole life only invested within 2 miles of the Stanford campus, real estate within 2 miles of the Stanford campus. Never did anything else, right? And if you walked with him around Stanford, every building, could tell you the history of every building, could tell you what the rents were, what could be bought for. And basically, he was sitting very underleveraged. And when the downturns came, he picked up a bunch of stuff and then, sat there. And then again, very underleveraged, next downturn, picked up more stuff and just kept going at it. And so he had a very narrow circle of competence. It wasn't even real estate. It wasn't even California real estate. It wasn't even Northern California real estate. It was just very, very narrow, but he was very successful. And I think in investing, that type of depth can be really useful. So I'm always interested in going deeper versus wider. So that's the way I would suggest.
I want to go back to the Turkey example. So you're new to this concept, let's say, making business within Turkey. You have different experience. You're reading this wonderful company that they had such a big gap between the fundamentals and market and etc. If I were you, tons of red flags will come up and I would say, you know what, doesn't make sense. But if you continue to kind of push forward and said, I'm willing to meet with the management, I'm happy with that. Why you were doing that? Maybe can you take us to the mental model that you kind of said, you know what, maybe I don't understand fully, but I'm willing to continue. Because a lot of people probably will step back in that case.
Yeah, so there were a couple of things. One is I couldn't put much in. So, it was going to be 1.5% of what I was managing. So first of all, even if I wanted to, this wasn't going to be a big bet because just the size of the bet. And the second is that when I went through the kind of list of things, kind of what I was going through in my head, is one of the things that was very important to me in Turkey is I wanted to make bets where the currency was irrelevant and inflation was irrelevant. So every bet I looked at in Turkey, I said, if inflation is 1,000% a year, the currency declines by 95% a year, what happens to my bet? And there were a few bets that I could have made where if those were true, we would still do very well. And this was a case, a warehouse is land, cement, steel, concrete. That's what a warehouse is. All of those are inflation indexed. So if we have crazy inflation, then the price of steel is going to go up. And the price of land is going to go up. And rents are going to go up. And in fact, last 6 years, we saw crazy inflation, crazy everything. And their contracts were inflation indexed. And they were actually, the contracts aren't even that great because they get indexed based on the official rate, which is understated. So they're not able to increase rents even at the rate of inflation. The bet has still worked. So Reysas' entire portfolio is sitting at below market rents. If they were to release the whole thing today, the income would almost double. So even with that lag, it has still worked because these factors were more relevant, that we were not going to be. There's another bet we had made in Turkey, which I think in the end we'll end up making more money than we will in Reysas because I could make a full bet there. So we were able to put 100 million in the other bet. So that's TAV Airports. And TAV Airports is basically almost all their revenues are in euros or dollars. So they're not even, the top line is not coming in lira. They pay their employees in lira. So they actually are a huge beneficiary. The employees get poorer every year because wages are not going up at the same rate of inflation. So they actually have a tailwind they're getting because of inflation. But TAV Airports it was sitting very cheap, not as cheap as Reysas, but we were able to put more capital in. So I think in the end of the day, I think just in terms of raw dollars, we'd probably make more there than the other place. So I didn't see, what I was clearly seeing in Turkey was extreme panic. And I remember that when we were buying Reysas, Templeton Fund, so there was a mass exodus happening. The foreign investors were all leaving. Door wasn't big enough for them to leave. Templeton Funds had a 5% position in Reysas, which they sold to me for $1 million. Okay, and they probably knew better than me what that position was worth. But some guy in New York said, exit Turkey. So that's what they were doing. It didn't matter what the valuations or anything were. I didn't see a lot of issues with that investment, partially because of the bet size and also because of the simple nature of the bet.
So thanks for your time making this. My question is what's your filter process? Probably which ideas you want to spend more time, specifically the coal mining industry, how you figure out, okay, I want to spend more time on this industry and then decided to concentrate investing in this industry.
I like your approach, which is forget all the nonsense about the past. Can we talk about stock tips? Is that where we want to go here? Well, actually, the thing is, I'm opportunistic, right? So I don't know what I will be investing in a year from now or 2 years from now, or I would not have forecasted that I would have made a bet in the coal industry 2 years ago. I wouldn't have guessed that. But, things show up on the radar. They sometimes make sense. I think the thing is that you try to do things where things hit you on the head like a 2x4, where it seems very obvious. Even when it seems very obvious, you'll still not be right many times. And the good news with this business is, like you saw with Buffett's example of 4%, is it's a very forgiving business. Or we saw with the Nifty-Fifty, 98% error rate, you still do okay, right? So we don't need to always be right about everything, and we're not going to always be right. Just because when we are looking at businesses and we're looking at where they will be in 1, 2, 5, 7 years from now, that can get very murky. There are too many variables that can come in that can affect it. Thinking I had on the coal business is relatively straightforward, is that in order to have a civilization, humans need iron and steel. You cannot really have a civilization without iron and steel. The way iron and steel is made, most of it needs to be made in a blast furnace. If you make iron and steel in an electric arc furnace, that's usually made out of recycled steel. And usually you will not get the highest quality of steel coming out of that. You also need a lot of recycled steel, which places like India, etc., don't have because they're just growing so much. One assumption is that it's difficult to change some of these processes. So it's difficult to change how iron and steel is made. So if it is correct that 30 years from now or 50 years from now, iron and steel will still be produced in blast furnaces, then for every ton of steel produced, you need 0.7 tons of metallurgical coal. And metallurgical coal only exists in very few places around the planet, just a few geographies. And coal is a four-lettered word. Nobody wants to open a coal mine. And when one gets closed, it's difficult to get it restarted. So we had a situation in 2023 where we had a bunch of coal companies, metallurgical coal companies, which had no debt. A mining company with no debt is an oxymoron. That just doesn't exist. But they had made so much money in 2022 with the Ukraine war, supernormal profits, that they all wiped out all the debt on their balance sheets and they became debt-free. So we have these companies that are debt-free. And, so if you have a business that's going to produce cash flow for, let's say, 50 years, and over 50 years, that cash flow will vary between maybe 0 to 100 million a year on the low end to maybe a couple of billion a year on the high end each year, and the market cap is 2 billion, where do I sign, right? So that's the bet, is we buy a business for 2 billion and we just sit and go to sleep. Let's wake up in 20 years and see what happened.
I think the stats you showed on Buffett, 4%, that's really interesting. I think my takeaway from that is it's really hard to know what your great decisions are ex ante. So knowing that, how do you think about just sizing those decisions and bets that you make in your portfolio?
Yeah, that's correct, actually. So I think Warren would not have been able to tell in advance what his 12 great bets would have been. He only knew Ajit was great 20 years later. So you're not going to know that either. If God doesn't know that, then we are not going to know that for sure. But that's why we have a portfolio, and we don't need to have 2 of everything like Noah. But what we can do is, if you have 10 or 15 bets, what is going to happen is that if you've done the work and you've got maybe 1 or 2 outlier winners, it's going to become obvious. You only learn a business after you own it. So you may do all the work you want, but you're really going to get your education on the business after you own it. And you get a really good education when it drops 50%. That's when you truly understand the business. So basically the bottom line is we make these bets, we think they're all great, and then we realize they're not all great, but some of them are great. And then we try to hang on to those, if it makes sense. So that's the way it is. I don't think there's a easy way to improve on that. If you look at a business like Amazon, Bezos, his approach has been a lot of small bets, a lot of stuff thrown up against the wall, very high failure rate, and very rapid innovation. And that works, because if a bet doesn't work, it's irrelevant, doesn't matter. And it's the ones that work that cannot drive it. So
one of your main points during the presentation was that you should never sell a high quality business because it's overvalued even if it's 95% of your pile. If you take the Moody approach and invert in that, why wouldn't you today be finding the highest quality business you can and then investing 95% of your net worth into it, regardless of the valuation? Like, that doesn't seem a low risk or an appropriately risked approach. But isn't that the same as making a decision in the inverse?
Well, the one issue is that if you bought something and it was 5% of your portfolio and then it became 95%, you are now rich. But if you just start off with the 95% in the best business, how are we going to get rich? What I'm trying to say is that now so we just talked about that we cannot tell in advance which ones are going to do well. What you're doing is you're taking a yesterday's winner, you're putting everything into yesterday's winner and saying that yesterday's winner is going to be tomorrow's winner. That's effectively what you're saying, right? Because what I'm saying is we know that Amazon is great, right? And we put everything into Amazon today. It could work. The way I'm wired, I wouldn't be able to make that bet because I wouldn't be able to get the conviction. It would be easier for someone like me with my wiring to go and make 10 or 15 bets where each one looks undervalued, looks like a good business, looks like all the pieces are in place, and then let it play out.
But even if you're so wide to have that conviction and you're well for that one position, doesn't it still make sense to follow that approach? Like say, take the example that Frank invested $100,000 into Amazon 20 years ago and now he has $10 million.
Yeah.
And I'm investing in Amazon today and I have $10 million. So we're both at kind of at single point in time putting $10 million into Amazon. Are you saying that would be still an optimal strategy for Frank because he has the conviction built up over time, but it wouldn't be optimal for me?
Well, the one chink in the armor I see for Frank, sorry to make you a guinea pig, Frank. One chink in the armor that I have is that I prefer the Nick Sleep approach where I don't have one bet, right? I mean, so the Walton family took the approach of one bet. Nick Sleep took the approach of 3 bets, right? And one of those 3 bets effectively is an index kind of bet, like Berkshire is like an S&P type bet. So it's very difficult to see something like Berkshire going. But if, let's say Frank has 10 million, and let's say Frank has 5 million in the S&P 500 and 5 million in Amazon, and he goes to sleep, I think that's fine. Even though the S&P probably overvalued whatever else right now, it's okay. I think he's not going to go back to zero. You know, like Munger says, I don't want to go back to Go again. I've been at Go. I know what Go feels like. I don't want to go back to Go again. So in his case, the 5 million each is a very comfortable situation to be in because no matter what happens, he's fine. He's still got the second 5 million if something happens to Amazon. The 95.5 with 9.5 million in Amazon. Now I need to have a lot of conviction in Amazon, whereas he doesn't. Whatever happens to Amazon is irrelevant to him, but it will be very relevant to you. So I think that's where some of this. So what I would say is that the all eggs in one basket is a little extreme for me, at least. I mean, the Waltons have done that. Steve Balmer has done that. Many people have done that. You know, Elon is doing that to some extent, though he's trying to spread it out a little bit. So if you just change it from the 1 bet to maybe 2 bets, where the second bet is a little bit more resilient, like a Berkshire and S&P, then I think you can totally relax. But some people can be totally relaxed, like the Walton family with the single bet, because they maybe have an understanding of Walmart that goes way beyond what I can understand. But these are valid questions. I'm not sure I'm giving you the right answer, but just telling you what I can process. So, yeah.
Another way of putting like George's question is that Frank puts $100,000 in 10 stocks. Amazon is one of them, sleeps for 20 years, is now 95% of the portfolio. Shouldn't he look for another 10 stocks and sleep for another 20 years? Rebalance the portfolio at that. I mean,
the title of the presentation was "You only need to get rich once." We're already rich. He doesn't want to work anymore. He just wants to lay back and relax, right? I mean, I'm just playing devil's advocate. What I'm just trying to say is that if I look at a Berkshire or any of these successful entrepreneurs, they end up in the end, you end up concentrated, right? What you're saying is, let's now restart. We've run this thing through, let's redo, right? Let's play the game another 20 years with new bets. And that can be very valid. That can work out. But we also have a couple of things to keep in mind. One is we have finite lifetimes, right? At some point we pass away or whatever else. It may take you 20, 30, 40 years to get to that point. If you are focused on staying rich, then I don't know how much sense it would make to take the whole thing and do 10 more bets. You know, because if you buy into the law that 95% of what you think is going to do extremely well is not going to do well as you think, and you already have one goose that's laying a lot of golden eggs, why kill the goose? The next goose may not lay any eggs. But, you know, nothing ventured, nothing gained.
So when you think about the next restart portfolio,
how do you deal with the boredom that comes with it? And also,
I'm sorry?
how do you not get bored? Like,
How do you not get bored?
like what do you realize in
So-
sitting there with the investments, but you're not going to do anything with it?
We need to be really good and happy watching paint dry. Can you be excited about watching paint dry for 20 years? Because that's a beautiful skill to have. But the way to do this is, a couple of weeks back, I was at the Bridge National Championships in Memphis, where all these nutcase bridge players are going all in for points. It's not even dollars, for points. I don't know why they get excited about points, but they're all super excited about points. We can find other ways to use the brain power. So, Munger says that it's a really good thing that Buffett played bridge, because if he had put that time into Berkshire, it would have had a negative impact. So one of the issues with investing is everyone in this room except me has too much brain power. Okay, like Warren says, you can give away 50 IQ points and your results are not going to change. They might even get better. It's a very important skill to build, to be able to, the Pascal quote, all man's miseries stem from his inability to sit alone in a room and do nothing. And actually, Pascal misspoke. What he actually meant was all investor miseries stem from their inability to sit quietly in a room and do nothing. So you have to be able to go through several decades of no activity. Can you do that, Alex? It's the most important thing to learn. The most important thing. And there's a hack, a very easy hack. Just find something else you're excited about, which doesn't involve dollars or money or investing or anything. You can become a bridge player. You can become a golf player. You can go race F1 cars, whatever. Find something else. Activity number 2, which is going to suck up all the time, so that you will live an excited life with the portfolio not being touched. So Nick Sleep, actually, I think he's in nirvana. That's where we have to get you to, Alex. We have to get you to nirvana before you enter the real world. Okay, we have very little time left. Can we have a course on it?
Oh, thank you so much for the sharing, and I really appreciate the humility and humor inside your speech, and also the wisdom share. I found the Coca-Cola charts very intriguing. On Dodd, Coca-Cola is a very it's a quality business, but I think some part of the stock growth also attribute to the series of QEs the market experienced after the financial crisis. And with the current economic condition and the debt level, I think the next QE probably is not in the near horizon. Do you think there is a foundation of is a change of foundation of the market conditions, and how do you suggest us to navigate this new environment?
Coke is a very complicated business. It looks simple, but it's actually very complicated. So there is a talk Charlie Munger gave on Coke. Have you read that talk? Okay.
It's worth reading.
Yeah. So basically, the way to think about Coke is percentage market share of the fluids consumed by humans globally every day, right? So we need 64 ounces or something per day to stay alive. And some portion of that needs to be flavored so that we don't get bored. Yeah. So if you gave Alex only water, that would not last more than 2 days. So some portion needs to be flavored. And then the thing is that there's a distribution engine that Coke has, which gets that flavored thing to several billion humans at a cost that almost no other company can do. So it's not, when we think of Coke, you immediately go to sugar and those sorts of things, but it's really a flavored water delivery mechanism. And flavored water delivery mechanism doesn't need to be unhealthy, right? It can be anything. Their pipe, the Coke pipe, you can pump anything through that pipe. Rebuilding that pipe by somebody else is very hard and very expensive and unlikely to happen. And what Coke can do is they just can look around and say, oh, Gatorade looks good. Let's just buy Gatorade and send it through the pipe, for example, right? They don't need to actually come up with the stuff that needs to go through the pipe. But the point is, yeah, I mean, I would say that's why I said that a business like Coke to me is more resilient than a business like Microsoft for that reason, because of that pipe and because unless humans stop needing that amount of liquid, that equation stays, right? And so even though you've got other players, but there's only like 2-3 players in the world that have enough bandwidth on that pipe and enough kind of cost advantage on that pipe. So the way I look at it with Warren and Charlie is that, in the mid 80s, late 80s, they cracked fundamentals of what Coke was. And of course, they had a huge run up. They made a lot of money in the next 10 years, 12 years on Coke. And they didn't make so much money for a while, but now it's again, like you only need to get rich once. Basically, if you have something like that in your portfolio, don't try to optimize. Just, there's a podcast called the Founders Podcast. I don't know if you guys listen to it. I tend to overdose on it. I think I've listened to like more than 100 episodes so far, but he keeps putting out more. I'm listening to the one on, what's that woman's name? Harriet Green. I think that's her name, Harriet Green. Her father was very successful and wealthy. He didn't want a daughter. He wanted a son. He wanted to transfer business acumen to a son. But, Harriet lived maybe more than 100 years ago. But anyway, he ended up with Harriet being his only heir. So he was forced to teach her business. And he was forced to basically explain to her how to do well, etc. But when he passed away, and she was really pissed off when he passed away, even though she was super, super smart and ended up being 10x better than the father ever was, in his will, he said he gave the entire family fortune to her, but he put it in a trust. And he made the trustees a few men, not her, who would control how the trust was invested. And all Harriet was getting was the income from the trust. So if he left her like 10 million, she was getting like $500,000 or something, 600,000 a year, right? From that stream of the little bit of money coming out, she blew past the principal by a huge factor, like really went way beyond. So basically, the idea is that you can have Coke and you can think like Harriet. And, for Alex's benefit, we can give him the dividend of Coke to go have fun with. How's that? Then we can do it like Harriet, He can go all out on the dividend, leave the principal. And that can work too, because Harriet proved it can be done,
What's your view on, you said never to sell a great business just on valuation? What's your thought on hedging it and be like, all right, like it's at 50 times EBITDA or whatever, and maybe it keeps on going even better than I think it can. So we buy some puts, and then I'd rather lose X amount of puts than sell the stock and have it keep going up.
Yeah, I mean, I think it's possible. Issue with hedging is that hedges are not perfect. Hedges can be expensive. Then they expire and you got to kind of redo it and all that. I think if it were me, I would focus more on using that resource and horsepower for something else. But it could work. That might be okay. But like I said, I go back, to me, Nick Sleep is a gold standard. No hedging, no nothing. He's got 3 of them. He's got 200 million. It's 60, 70 million each one. He doesn't need more than 10, 20 million to have a good life. He's giving it all to charity anyway. So why try to get cute? All this falls into the cuteness category. Like buying ASOS. That was getting cute.
So I guess with coal, like you went top down, you liked the sector and then you picked the companies you wanted. With Turkey, you liked the country, you picked companies you wanted. Do you ever go bottom up, or are you just like a top down investor?
I'm actually bottom up. I'm not top down. I actually usually start at the business. And actually coal has been interesting because in 2 years, as my understanding grew, I spent 15 days in the coal mines last year, and it was an orgasmic experience. Coal miners are the best people to hang out with. Just awesome people. And but as my competency grew in coal, I found myself shifting, kind of which company and all of that. And I think I finally got it nailed. It took a couple of years to get that kind of head screwed on right about which one and whatever. But in general, I think if you're investing in a commodity business, if you're investing in a mining company, for example, the low-cost producer is going to win. So you have to make sure there's no leverage, because then you get to play your hand out. You have to make sure that you are best management team and lowest cost. And the lowest cost producer will always be produced. So it's not that hard to figure out which ones those are and then go to sleep.
Yeah, you spoke about yesterday's winners, and you said like you're wired to like not sort of bet on them. Just from the
I'm sorry, bet on what?
Yesterday's winner.
Yeah.
But then just going back to the Walmart example, from 1970 to 1990, I'm assuming at 1990 it looked like a yesterday's winner, but even if you invested in 1990 and you rolled it forward in 2025, how do you sort of take a bet on the durability of a great business? And just because I think doubling down on a great business is...
Yeah, no, I think you have a very valid point, and he has a very valid point, in the sense that Amazon could very well be in its infancy today, right? I mean, we may look back in 30 years and say, oh, this was a bargain even in 2025, right? That's entirely possible. In fact, likely. Not even possible, I think it's likely, just because of the way that business is run.